The AI bubble just popped, but the AI opportunity is just beginning. And if you're still buying chip stocks, thinking you're investing in AI's future, you're about to watch the next 12 months destroy your returns while a completely different group of companies multiplies investor wealth by 5, 10, maybe even 20 times. I'm going to show you exactly where the smart money is rotating right now, which stocks are about to explode, and which former darlings are going to bleed for the next 2 years. Because what's happening right now is the biggest sector rotation I've seen since cloud computing took over from hardware in 2015. And just like back then, most investors are going to get this completely wrong. Let me start by showing you what's actually happening in the market, because the headlines are missing the real story. Over the last 3 months, the Nasdaq is basically flat. Looks boring, right? But underneath that calm surface, there's absolute chaos. Chip stocks are down 15 to 25% from their peaks. Meanwhile, software companies focused on AI applications are up 30, 40, some even 50%. This isn't random volatility. This is a rotation. And rotations like this create massive wealth for the people who see them early and position accordingly. Here's why this is happening and why it's going to accelerate over the next 6 to 12 months. For the last 2 years, AI investing was simple. You bought the companies making the picks and shovels, NVIDIA, AMD, the chip designers, the data center infrastructure plays. The logic was bulletproof. AI needs compute. Compute needs chips. Therefore, chip stocks go up. And it worked. NVIDIA went up 10 times. AMD tripled. The infrastructure trade was the easiest money in a generation. But here's what always happens after an infrastructure build-out. Once the rails are laid, the real value creation shifts to the companies running trains on those rails. We saw it with railroads in the 1800s. We saw it with the internet in the early 2000s. We saw it with cloud computing in the 2010s. Now we're seeing it with AI. The infrastructure phase is over. The application phase is just beginning. And if you're still overweight semiconductors, you're holding yesterday's winners, while tomorrow's winners are leaving you behind. Let me give you a concrete example that'll make this crystal clear. Palantir. Yeah, I know, controversial stock. People either love it or hate it. But look at what's happened. Palantir's up over 400% in the last 18 months. Why? Because they took AI and turned it into actual enterprise software that companies pay millions of dollars to use. They're not selling potential. They're not selling infrastructure. They're selling productivity gains, cost savings, and competitive advantages. That's what enterprises actually buy. Or look at ServiceNow. Their AI products are generating over $1 billion in annual recurring revenue. That's not a projection. That's money in the bank right now. Stocks up 60% in 12 months, while the semiconductor index is barely positive. Do you see the pattern? The companies making money from AI applications are outperforming the companies making the chips that power those applications. Now, before half of you run to the comments to defend NVIDIA, let me be clear. I'm not saying chip stocks are going to zero. I'm saying the risk-reward has fundamentally shifted, and if you don't adjust your portfolio accordingly, you're going to underperform. Here's the framework for understanding this rotation, and this is critical. In any technology cycle, there are 3 phases. The infrastructure phase, where you build the foundation. The application phase, where you build useful products on that foundation. And the commoditization phase, where the infrastructure becomes cheap and the applications capture all the value. AI infrastructure is transitioning from phase 1 to phase 3 faster than anyone expected, and we're just entering phase 2 for applications. Why is infrastructure commoditizing so fast? 3 reasons. First, competition. It's not just NVIDIA anymore. AMD is catching up. Google has TPUs. Amazon has custom chips. Microsoft is designing their own silicon. The chip oligopoly is fragmenting, and that means pricing pressure. Second, efficiency gains. Remember DeepSeek? That was the wake-up call. You can do more with less. Models are getting optimized. Training costs are dropping. The industry is figuring out how to squeeze more performance out of cheaper hardware. Third, oversupply. Data centers are being built at a record pace. At some point, Probably in the next 12 to 18 months, supply is going to exceed demand. When that happens, chip pricing power collapses. Those three forces are converging right now, which means if you're betting on NVIDIA continuing to grow at 40% annually, you're fighting the tide. But here's the beautiful thing. While infrastructure commoditizes, applications are just getting started. And the application opportunity is actually bigger than the infrastructure opportunity ever was. Let me explain the math, because this is where it gets really interesting. The global AI chip market is projected to hit somewhere around $300 billion by 2030. That's huge, right? But the global AI software and services market is projected to hit over $1 trillion by the same time frame. The application layer is 3 times bigger than the infrastructure layer, and we're earlier in that cycle. So where specifically should you be looking? What are the categories within AI software that are going to produce the next generation of winners? Category 1, and this is the most obvious, AI native enterprise software. These are companies built from the ground up to deliver AI capabilities to businesses. Think about what Salesforce did with customer relationship management. They took a category that existed before, CRM, and moved it to the cloud. That transition created hundreds of billions of dollars in market value. Now imagine companies doing the same thing, but with AI at the core instead of cloud. They're taking knowledge work, data analysis, customer service, content creation, and completely reimagining those workflows with AI. Companies like C3 AI, even though they've been volatile, they're in this category. Scale AI, still private but watch for their IPO. Databricks, also private but valued at $43 billion. These companies are building the picks and shovels of the application layer. And here's the key insight. Just like cloud infrastructure became valuable, but cloud applications became more valuable, AI infrastructure will be valuable, but AI applications will be more valuable. Category 2, legacy software companies successfully integrating AI. This is a subtle but crucial opportunity that most retail investors are missing. Adobe is a perfect example. They've been around for decades. Photoshop, Illustrator, boring software company, right? Wrong. Adobe integrated AI into their creative suite with Firefly, and it's completely changed their growth trajectory. They're now growing revenue at double digits again after years of single-digit growth. Why? Because AI made their products 10 times more valuable to customers. Designers can now do in minutes what used to take hours. Microsoft is another one. Yes, they own part of OpenAI, but the real value creation is happening in their core products. Copilot in Office 365 is generating billions in incremental revenue. That's not infrastructure revenue, that's software margin revenue, which is way more profitable. Look for legacy software leaders who are successfully embedding AI into their existing products. Those companies have distribution, they have customer relationships, and they're layering AI on top to drive a new growth cycle. That's a much safer bet than trying to pick which AI startup is going to be the next unicorn. Category 3, vertical AI solutions. This is where it gets really specific and potentially really lucrative. Instead of trying to be AI for everyone, these companies are building AI for specific industries. AI for healthcare, AI for legal, AI for manufacturing, AI for financial services. The beauty of vertical solutions is they can charge premium prices because they understand the domain. A generic AI tool might cost $50 a month. A vertical AI solution built specifically for radiologists or contract lawyers can charge $500 or $1,000 a month because the ROI is crystal clear. Harvey AI for legal work, Hippocratic AI for healthcare. These companies are getting valuations in the billions even though most people have never heard of them. Why? Because the unit economics are incredible. One of these vertical AI companies could easily become a $50 or $100 billion market cap business in the next 5 years. The question is which one, and that's where the research comes in. But here's what you need to understand about this rotation. It's not just about picking the right stocks. It's about getting your portfolio positioning correct for the phase of the cycle we're entering. If you're sitting here with 50% of your tech allocation in semiconductors, you're massively overexposed to the part of AI that's maturing and underexposed to the part that's accelerating. Let me give you a portfolio framework that makes sense for this moment. If I were building an AI-focused portfolio today, I'd allocate roughly like this: 20% in remaining infrastructure plays, the chip stocks and data center REITs that still have growth runways; 40% in AI native software companies, the ones building products specifically for AI use cases; and 40% in legacy software leaders adding AI capabilities. That balance gives you exposure to the entire AI value chain while overweighting the parts that are going to outperform. Now, within each of those buckets, you want diversification. Don't just buy one chip stock. Don't put everything into one AI software name. Spread the risk because we're still early enough that some of these companies won't make it. But here's the critical thing. You want to be rotating out of pure play infrastructure and into applications now, while the market's still figuring this out. In 6 months, this rotation will be obvious to everyone and the easy money will be gone. Let me give you some specific names to research, and I'm not giving financial advice here. I'm giving you a starting point for your own due diligence. On the AI native software side, look at Palantir, C3.ai, SentinelOne for cybersecurity, UiPath for automation. These companies are volatile, but they're positioned at the center of AI deployment in enterprises. On the legacy software side, adding AI, look at Microsoft, obviously, Adobe, ServiceNow, Salesforce, Workday. These companies have proven business models and they're layering AI on top to accelerate growth. And if you want exposure to the picks and shovels of the application layer, companies that help other companies build AI applications, look at Snowflake for data infrastructure, MongoDB for databases, and Datadog for monitoring. Each of those companies benefits as more AI applications get built and deployed, but they're not purely dependent on chip demand. Now let me talk about timing because some of you are thinking, have I already missed this rotation? Short answer, no. We're maybe in the second or third inning of this shift. The big money institutions are just starting to reposition. Retail investors are still mostly in chip stocks because that's what worked for the last 2 years. The real acceleration happens when earnings start proving out the AI software thesis. We're going to see companies report 50, 60, 70% growth in their AI product revenue over the next 2 quarters. When that happens, the narrative shifts completely. Right now, you're early, not bleeding edge early, but early enough that the returns from here could be substantial if you pick the right names. But here's the risk you need to understand. Not every software company slapping AI onto their product is going to succeed. A lot of them are just doing AI washing, adding a chatbot to their interface and calling it AI strategy. The winners are going to be the companies that fundamentally reimagine their products around AI, the ones that use AI to deliver 10 times better outcomes, not 10% better outcomes. How do you tell the difference? Look at 3 things. 1. Revenue growth specifically from AI products. If a company says they're an AI company, but their AI revenue is negligible, that's a red flag. 2. Customer testimonials and case studies. Real AI value creation produces measurable results. Cost savings, productivity gains, revenue increases. If a company can't show concrete examples, they're probably not delivering real value. 3. Product roadmap and R&D spending. Companies serious about AI are investing heavily in research and development. They're hiring AI engineers. They're building proprietary models or deeply integrating third-party models. Those 3 filters will help you separate the real AI software plays from the pretenders. Now let's talk about valuation, because this is where a lot of investors are going to mess this up. AI software stocks are not cheap on traditional metrics. Many of them trade at 10, 15, even 20 times revenue. That seems insane if you're used to value investing. But here's the thing. When you're growing revenue at 60 or 80% annually and you have 90% gross margins and you're building network effects, traditional valuation metrics don't apply. You have to think about these companies in terms of their total addressable market and their ability to capture it. If a company can grow into a $20 or $30 billion revenue business over the next decade, paying 20 times current revenue might actually be cheap. But you have to have conviction in the growth story. You can't just buy expensive stocks and hope. You need to understand why the company can sustain high growth rates and what their competitive moats are. That's the work. That's what separates investors who make life-changing returns from investors who buy at the top and watch their money evaporate. Here's another angle that's not getting enough attention. The AI software rotation isn't just about public stocks. Some of the biggest opportunities are still private. Companies like OpenAI, Anthropic, Scale AI, Databricks, they're all private, and they're growing faster than almost any public company. If you have access to private markets through platforms like Forge or EquityZen, that's where some of the most asymmetric opportunities exist. Obviously, private investing carries different risks: liquidity risk, valuation risk, information risk. But if you can get into a pre-IPO AI software company at a reasonable valuation, the upside could be exponential. Just look at what happened with Snowflake's IPO. Early employees and investors made fortunes. The same thing's going to happen with the next wave of AI software IPOs. So if you're an accredited investor, start paying attention to the private market. That's where the next generation of $100 billion companies is being built right now. Let me bring this all together with a specific, actionable framework you can use starting today. Step 1. Audit your current AI exposure. How much of your portfolio is in chips versus software? If you're over 50% in semiconductors, you're probably mispositioned for the next phase. Step 2. Identify 3 to 5 AI software companies that fit the criteria I laid out: high revenue growth from AI products, clear customer value, strong R&D investment. Do deep research on those names. Step 3. Start rotating. You don't have to sell all your chip stocks tomorrow, but start trimming positions and redeploying that capital into the application layer. Do it gradually over the next 2 to 3 months. Step 4. Set up alerts for earnings reports from AI software companies. You want to see the progression of AI revenue quarter over quarter. That's going to tell you which companies are winning. And step 5, be patient. Rotations take time to play out. You're not going to nail the bottom in chips or the top in software, but if you get the direction right, you'll make money. Here's my final thought, and this is what I want you to really internalize. The biggest mistake investors make during technology transitions is fighting the last war. They extrapolate what worked yesterday into tomorrow, and they get destroyed when the market shifts. The chip trade worked brilliantly for 2 years. It made a lot of people a lot of money. But that chapter is closing and a new chapter is opening, the application layer chapter. You can either adapt to that reality, or you can hold on to your chip stocks and watch them trade sideways or down while software stocks double and triple. I know which choice I'm making, and I think if you're honest with yourself about where we are in the cycle, you know which choice makes sense too. So here's what I need from you. If this breakdown changed how you're thinking about AI investing, hit that like button. It tells YouTube to show this video to more investors who need to see it. Subscribe if you're not already subscribed, because I'm tracking this rotation week by week. You're going to want these updates as the story develops. And comment below. Tell me where you're positioned right now. Are you heavy in chips? Are you already in software? Are you making changes? The conversation in the comments is where we all learn from each other. Remember, the best returns come from seeing what's coming before the crowd does. You're here early. You understand the rotation. Now it's about execution. I'll see you in the next one. Let's make some money.